And welcome, everyone. Thank you for taking the time in an early morning, depending on where you are, to be with us today and really learn about a company that we've spoken about for quite some time. We've done a lot of work with John over the last several quarters of going through the progress that his company's making, all the different numbers that John's going to be going through as well over Q1 and Q2 of this year. But really, it's a testament to a company that's been doing what they told investors they would do. A lot of the cannabis space right now, a lot of these companies, they had these extravagant plans. You saw that people would be the biggest growers, or they'd be the biggest extractors. They would be exporting all throughout the world. And unfortunately, what people started realizing is that some of these plans may have been a little too optimistic. A lot of companies have been faltering over the last little while. And now we're really starting to see which companies have set up a proper business model, which companies are set to be here for the years to come, because the cannabis space, although a lot of the stocks in the cannabis space have made pullbacks since 2018, when everything went through that little bit of a crash and burn there stock-wise, this sector is so new, and this sector has so much promise as it continues to grow. And that's why I'd love to introduce John Arbuthnot, the CEO of Delta 9 Cannabis, to speak to you for a little bit. We're going to go through a presentation of a little bit about their story and how they came to be, but more so on the first half of 2020 and how his company is really starting to distance themselves from the pack in terms of showing profit, in terms of showing positive Ebitda, and in terms of doing exactly what they said they would do quarter after quarter. So with that, John, my good man, welcome.
Morning, Brendan. Thank you for having me.
Absolutely. Well, this is the time where I'm going to be turning off my camera for a little bit. I'll let you go through your presentation here. Please, I'd love in the chat room, if you're here right now, throw in what city you're currently viewing from. We'd love to see that. Please feel free to use that chat function. And then the Q&A function. After John is finished with this presentation, we're going to turn to your questions. This is where you can ask them in real time and live. We'll turn over there at the end of the presentation. We'll go through those one by one. We'll go from top right down to the bottom. So looking forward to it. And John, I'll turn over the camera and the mic to yourself now.
Perfect. Thanks, Brendan. And good morning, everyone. Thank you for joining us for the webinar and chat this morning. Real goal this morning is to do a brief introduction of the company, run through some of our second quarter results, keep it a little bit less formal than some of our quarterly analyst calls and things like that, but give you a good sense of kind of where the company's at, how we've been operating, how we've been executing over the last quarter, last few quarters, first half of this year. Give you some outlook as well into what the company's planning for the future, and then opening things up for question and answer session. Again, roll through, please feel free to ask any questions that you can. I think Brandon's hoping, people are going to throw some questions in while I'm speaking as well. So if something jumps to mind while I'm chatting through here, you want a little bit more clarity on, or would like some industry color, please don't hesitate. So before I start any of these presentations, I do have to go through, let you all know that there will be forward-looking statements as part of the presentation. As with anything, results for the company can differ materially from those that I put forward in the forward-looking statements. For more info on that, please do visit our financial statements, our MD&A, AIF, etc., which are available on SEDAR. But with the legal components out of the way, we can begin. The cannabis industry, the rollout, I think, as Brandon spoke to, legalization in Canada has, certainly come with its host of challenges. Companies had set quite lofty expectations. Delta 9 has always approached the industry with more of a slow, steady growth approach, and a little bit different than many of our competitors. Industry has encountered, I would say, significant headwinds, oversupply situation, lack of retail stores, etc. Obviously, there's been a fallout in the capital markets environment for cannabis over the last 12 to 18 months. Through all of that, we have really tried to chart a course, demonstrate that our financial and operating results, our business plan is sound. And we continue to do so on a quarter-over-quarter basis. The results that I'll be chatting through today for our second quarter are we feel, quite strong. A number of positive takeaways. I'll also highlight some of the challenges we've run into and what we are looking to do to improve that into the future. And, of course, our long-term goal here is creation of shareholder value. So we'll speak a little bit on our longer-term outlook as well. Firstly, we should mention, and I think this is probably the number one question we get from analysts and investors right now is, what are the impacts COVID-19 having on our business? Again, as you'll see in the financial results, we feel we've weathered the storm a little bit better than a number of other businesses, a number of other sectors. But we have taken a number of steps to address COVID-19. So firstly, on March 30th this year, we announced that we were implementing a number of health and safety protocols across our operations, really following those requirements as set forth from our provincial health and federal health officials. Things like physical distancing, obviously requiring PPE across our production operations, making that available for folks in our retail stores as well. Ensuring that staff and customers are physically distanced within our retail locations, spacing people out in checkout lines, putting up plexiglass screens, things like that. Our operations have certainly not been immune to COVID, but we are certainly looking to highlight for folks that we have maintained all of our separate business units. So our wholesale business continues to make shipments across the country. Our retail business continues to operate our stores, both in bricks and mortar and online for deliveries. And our B2B segment continues to make deliveries of grow pods across North America. So all of that has been maintained through COVID. There have been some increased costs as well. So we will speak to what the impact of some increased staffing and other costs have been for us as we highlight the financial components. Firstly, very high-level overview for Delta 9. We are one of the few vertically integrated operators in the Canadian space. So we're licensed for wholesale, cultivation, processing, extraction. We are licensed retailer, currently operating 6 cannabis retail stores across Manitoba and Alberta, and with plans to build out a chain of cannabis retail stores across Western Canada. We also operate what we call our business-to-business segment. So this is effectively sales of our proprietary growing platform, which we call our grow pods. Again, across North America, this does give us some exposure to the US market. We are able to sell grow pods into the United States where we can't sell cannabis. We also provide consulting and licensing services and sell cannabis genetics. So all of that encompassing our B2B segment. The company's shares trade on the main board, Toronto Stock Exchange, under the symbol DN, as well as OTC in the US under the symbol VRNDF. Now, on the cultivation side of our operations, again, what really makes us unique is how we grow. It's using that proprietary growing platform, which we call the grow pod. We do feel there's a number of benefits to this method of growing versus big open warehouse or greenhouse growing. And to put it very quickly, we feel that we can dial in these relatively small areas on a modular basis and produce a higher quality finished product. It also treats us much more like a manufacturing environment, again, giving us a better feel for automating certain processes, et cetera, which we feel are really driving efficiencies in terms of cost per gram and things like that. There's a built-in risk mitigation function in that all of these units are self-contained. If there is an instance of contamination, it's very unlikely that will spread throughout the facility and lead to systemic crop loss. So again, number of benefits to this type of platform. We're currently operating 297 of these modular grow pods licensed within our Health Canada licensed facility here. Gives us an overall cultivation capacity of about 8,325 kilos per year. So from a dollar value perspective in Canada's wholesale market, that's a current wholesale annualized value of about $25 to $30 million. Now, during the quarter, we also received approval from Health Canada for a purpose-built bottling center. I will speak to some of the challenges that we encountered in our processing throughout the quarter for our wholesale segment, but this purpose-built bottling center really key for us. It came online late in the second quarter. It fully automates all packaging, labeling, tax stamping functions, allows us to process up to 25,000 kilos per year of dried cannabis material. Really, I think continues to emphasize that that need for efficiency in terms of reducing costs and increasing output or flow through of our products into the market. In terms of our portfolio of cannabis products, obviously 2.0 products, gummies, drinkables, things like that, have really captured a lot of interest in the rollout over the last 6 months. Dried flower, though, continues to really drive the show. It's about 75% plus of industry revenue right now coming from that dried flower segment. So obviously, as we look to attack the market, dried flower, is really key in terms of driving market share gains and driving wholesale revenue. About 75% of our revenues over the quarter as well derive from dried flower, both through our retail and our wholesale segment. What we've seen over the last year to 2 years in the recreational market here in Canada, people are really pivoting towards high potency. So high THC is really driving the day. Again, within our production facility here, then we look to pivot our production to really cater to that high potency segment. We have a genetic seed bank here of several hundred strains of different cannabis. We're constantly bringing on new genetics, conducting analytical testing, really seeing what's unique from a chemical composition, a chemical profile, the THC profile, CBD profile. What are interesting products that we can bring to market? We have a very, I would say, a large pipeline of product for us to be able to continue to drive novel products into the Canadian cannabis space for the foreseeable future. Another big pivot in the Canadian space, in the flower market, in the last few quarters has been what we're calling the value segment. These are products that should retail for between $4 to $6 per gram, and it really is the black market competitors. A lot of negative feedback in the first year or so of legalization from consumers was that the legal market was just not competitive. Selling products for upwards of $10 a gram was not competing with Canada's black market. These value segment products are directly competing with that black market, really looking to bring consumers over who have been hesitant to shift from the cheaper products in the black market. So we'll be launching 3 value products in the third quarter this year: Delta 9 Indica, Sativa Hybrid in the mid-range THC category. In our own stores, these products will retail for in the area of $4 to $5 per gram. So we'll be our first entrance into the value segment, but from what we're hearing out of markets like Ontario, these value products are now comprising about 30 to 40% of flower sales. So I think will be important for us to make a splash into the value segment. Pre-rolls, also increasingly important segment, especially over last year and continuing into this year as consumers really look for value and convenience in a pre-rolled product setting. So we have 4 different pre-roll products on the market right now. 2 of them are our top selling products in our own retail stores, our Delta 9 Bliss and Twist products, or mid and high range THC pre-rolls. We've produced and sold hundreds of thousands of pre-rolls. Now, something we will be looking to in the future will be to automate our pre-roll functions so that the semi-automated processes that we have right now, again, become more and more efficient, to continue to drive those efficiency gains. In terms of 2.0 products, companies undertaking a number of strategies in terms of expanding into 2.0. We do believe that 2.0 products will become increasingly important as the Canadian cannabis sector evolves. Our first entry into 2.0 products is what we call the dried Sift cannabis, essentially keef. So it's effectively a cannabis powder with a THC range between 30 and 40% THC. So very high on the THC spectrum. We bring that product to market for about $9 wholesale. Product has been a #1 seller over the first quarter of this year. We've ramped up our production of that product into the third quarter. We've only been selling it in Manitoba to date, but we will be looking to branch that out into other provincial markets into the future. Vape products will be our next entry. We should have our first vape products to market in September or within the third quarter, if not very soon into the fourth quarter. We're working with an extractor out of Calgary, Alberta, called Decibel or Westleaf Labs to manufacture those units for us, all branded Delta 9, 3 different potency formulations in the 510 carts and disposable category. So that'll be our next foray. We are actually seeing that vape products have been the #1 impact category in terms of 2.0 products. They are making up the largest proportion of 2.0 product revenues in our retail stores currently. So our entry into that category, I think, will be an important first step for us into 2.0. But then, of course, we're carrying the full scope of these products through our retail stores from all of the industry's leading manufacturers. We're gathering valuable market intel on what's working, what's not working. And when we look to invest in new product categories, we will have a very good sense from the consumer of how we should be looking to invest and enter those categories. From a wholesale standpoint, the company has a few different strategies or several different markets on the wholesale side. We are now licensed in 6 Canadian provinces. So at the beginning of the quarter, 4 main supply agreements, 4 provincial markets, Manitoba, Saskatchewan, Alberta, and BC, all of the western provinces that we're distributing in. We have undertaken, I'll call it an incremental approach. So as our supply capacity has come online, has ramped up, as we've gotten more efficient, we have taken on more markets, essentially one after another, to continue to expand our distribution. Within the quarter, we brought on the province of Newfoundland. First off, we entered into a partnership with a local vertically integrated Newfoundland-based company called Oceanic Relief. They are currently building out a 50,000 square foot facility in the province of Newfoundland, as well as several retail stores. So we have partnered with that local company. We signed a distribution agreement with the province of Newfoundland. We have actually already made wholesale shipments into the province of Newfoundland within the third quarter here, and we'll continue to expand that partnership with the province and with our local partner there into the future as they look to open retail stores and so on. Ontario, I think most notably, signed an agreement with a few days left in the quarter on June 23rd this year in the province of Ontario. So we'll be bringing our first products into Canada's largest province, again within the third quarter here. Real push for us has been to be in these largest markets. We are now participating again in 6 provincial markets, making up more than 60% of Canada's population. So we're now very well represented from a wholesale standpoint across Canada. Our job is, again, to continue to see positive sell-through of our products in these markets, positioning the product so that we are really creating value for the consumer and really putting the Delta 9 brand on a pedestal in front of the Canadian cannabis consumer, making sure that they're seeing value. In terms of vertical integration, again, we talked retail. Company at the beginning of the quarter was licensed for 4 cannabis retail stores, all in our home province of Manitoba here. We've been vocal that we feel there's a number of benefits to retail. It gives us control over the direct-to-consumer sales force, the bud tenders who are really driving people's purchasing decisions. It gives us control over branding and marketing initiatives in retail stores, which is one of the few avenues that we actually have to advertise ourselves and our products in the Canadian cannabis market. Obviously, we capture additional revenues, meaningful revenues, gross margins, and profits coming from our retail segment. And we get direct feedback, live analytics. Again, as we talk 2.0 products and things like that, the value that we see from retail is in the data collection that we're able to pull out of these transactions. Within the quarter, we also announced that we closed on a previously announced transaction to acquire 2 stores in the province of Alberta. This is our first expansion into the province of Alberta, again, now operating 6 stores. We do have a 7th store that is built out and is ready to open here in our home province. We'll be expanding up to 12 operating locations in our home province over the next 24 months and plan to continue to expand into Alberta, Saskatchewan, other markets that allow for vertically integrated cannabis retail through a mix of organic store builds and acquisitions through the next 12 to 24 months. So more to come on that, again, as these transactions are inked and as we start to have enough information to share with investors. On the B2B side of our business, this is the really unique part, more of the infrastructure play for us. Again, it's sales of our proprietary grow pods and platform. This is the unique part of our business where we can actually see revenue from the United States, where we can't sell cannabis, but we can sell infrastructure and cannabis equipment. So it gives us some exposure to the growth in the U.S. Cannabis market over the next number of years. While our sense is that the Canadian market continues to be a good investment for us on B2B, we do have a sense that the much larger, much more rapidly expanding U.S. market will become increasingly interesting over the next number of years. So in terms of actual Q2 financial results, firstly, I'll touch on the balance sheet. Company has worked very hard to maintain a clean balance sheet to make sure that we haven't, taken on, I'll say, excessive amounts of debt, but that we are using debt reasonably, responsibly to leverage ourselves on a non-diluted basis to increase our capacity as our company has expanded. We're very fortunate to have a working relationship with Canadian Western Bank, a Tier 1 charter bank here in Canada, where we have an $18 million credit facility. To date, we've only used about $10 million of that. So there's about $9 million, I believe, remaining on that credit facility. We do have significant access to additional capital through that credit facility. In terms of the end of the quarter, company had $6 million in cash, about $24.5 million in working capital, and about $77 million in assets. And again, we feel that the debt to equity mix, the debt to assets mix, has been very stable as the company has expanded. It's something we continue to monitor in terms of the financial health of the company. We would emphasize that given the company has reached a position of positive cash flow, as I'll touch on in a moment, positive Ebitda and operating income, that we feel that the company is quite well positioned from a cash standpoint to continue to expand our operations into the future. Now, in terms of the actual operating results for the quarter, I think a number of positives to touch on. Revenue for the 3-month period for the second quarter this year was $13 million. That was up 46% from the same period the previous year, from $8.9 million, and up 11% from the first quarter this year at about $11.75 million. So significant not only year-over-year growth, but also quarter-over-quarter growth. And keeping in mind this was into a global pandemic, I think we're feeling very positive that the company was able to achieve such significant revenue growth in the second quarter. In terms of revenue segmentation, where did we see this revenue coming from? About $8.2 million of that revenue was from our retail chain. It really was the shining star for us within the quarter. That was up from $5.8 million in the first quarter this year. So again, significant quarter-over-quarter growth, and most of that growth coming from same-store sales growth. We only opened our 2 Alberta stores very late in the quarter. So again, vast majority of this revenue was coming from same-store sales growth, and a few factors playing into that. Firstly, we're seeing increased foot traffic in our retail stores. More people are coming in. More people are coming in from black market. More people are coming in for 2.0 products. More people were coming in through the pandemic generally. I think there has certainly been an uptick relating to COVID-19 in retail sales. We're also seeing increased online activity. As COVID-19 ramped up, more people were wanting access to contactless shopping options, being able to order same-day delivery or mail order delivery online, and click and collect services. So that actually making up about 10% of our retail revenues in the quarter, being very substantial. Average cart sizes have also increased, so up to about $52 per transaction. And again, that's a mix of people adding 2.0 products to their carts, increased purchasing habits through COVID, but also increased online activity, where we see average carts are actually a little bit more than $100. So again, online continuing to be a very strong point for us through the first and second quarter this year. In terms of wholesale revenue, was about $1.45 million for the quarter. This was down actually rather significantly from the previous quarter. It's one of those points of weakness that we'll look to touch on. So really, the challenge for us through COVID was not our retail operation. It was physical distancing in our production and wholesale operations, where a number of activities such as bottling, labeling, tax stamping, at least for much of the quarter, were done manually. In these areas, we would typically have 15, 20 people at a time conducting these activities. And due to physical distancing, we were having to limit that to only a very small number, 4 or 5 people at a time. So it really limited our ability to bring product through to the market, release it for sale, and drive essentially wholesale sales into the market. So that has been rather limited. Now, how we're looking to improve that, we did, as I mentioned, receive approval from Health Canada for a new purpose-built, fully automated bottling labeling line. So essentially, it's taking a lot of those manual processes and it's automating it. So now all of our dosing of our material into our bottles, into our containers, induction sealing, capping, labeling, tax stamping, case packing, all of that fully automated and ramped up into our new areas. So we do feel that our wholesale business will rebound strongly into the third quarter. But we would point to as well, we're continuing to see pricing pressure. The Canadian cannabis wholesale market continues to be saturated. It's a very competitive market environment. That's where we continue to have to drive production cost efficiencies. And, it's a lot of these investments in automation that was made over the last number of years, which are going to make us competitive. Our cost per gram for the last 4 quarters has been under $1 per gram. That puts us in a very competitive position with even our largest competitors to continue to position competitively in the Canadian cannabis wholesale space. So we really look at that from a management perspective as a point of emphasis for us, something we need to improve for the third and fourth quarter this year. And again, certainly expect to see a rebound from the second quarter results this year. B2B, our grow pod and consulting business continued to be strong through COVID in the second quarter. Little over $3 million. That was up modestly from the previous quarter. Again, very strong result for us, and I think demonstrating the resilience that comes in having these three very diversified segments, where one is underperforming, but two are performing quite strong. The company is able to produce a top line beat. Again, consolidated revenue of $13 million. From a gross profitability standpoint, gross profits for the quarter were about $4.6 million. That was down modestly from the previous quarter. The impact to gross profitability from this shift in revenue mix was a little bit of a drag on gross profitability, where we make less money from a gross profit standpoint in our retail segment versus our wholesale and B2B segments, which are much more profitable from a gross profit standpoint. So we look to improve that in a few ways. Again, increasing our revenue mix proportion from retail and B2B sales. I think that will continue to improve in the back part of the year. As well, the introduction of 2.0 products into our overall product mix, both in retail and wholesale, should drive improvements into the back part of the year. Net income from operations was positive $1.7 million. Again, quite positive for us. That was up from a loss of $1.1 million in the same quarter the previous year. We're one of very few Canadian cannabis operators who is producing positive net income from operations for the second quarter this year. Adjusted Ebitda is a very important metric for us. It essentially takes our net income and factors out the biological asset adjustments. So it takes out any non-cash items that may be affecting the income statement. Adjusted Ebitda was positive, about $700,000 for this quarter. That was up from an Ebitda loss of $700,000 in the previous year. So modest, I would say, significant improvements over the previous year, but both of these metrics were down modestly from the first quarter. And again, a little bit of the drag here was increased costs due to COVID. The company actually incurred about $500,000 in costs, a mix of increasing pay for our frontline staff. We wanted to make sure that our frontline staff were feeling appreciated through the pandemic. So we implemented what we called grateful pay, an extra $2 an hour, as many other retailers and companies that remained operating through the pandemic did. I think it was the right thing for laborers using staffing firms. We had to increase sanitation protocols. So sanitation costs and sanitation supplies and materials costs increased in the quarter as well. So that additional $500,000 in costs really was a drag for us in terms of how that impacted the bottom line. Companies now produce positive operating cash flows for the last 2 quarters. Positive adjusted Ebitda for the last 2 quarters, and positive net income from operations for the last 3 quarters. And again, we're in a very select few cannabis companies that's been able to produce those positive results for several sequential quarters. As I mentioned, company ended the quarter with a strong financial position, over $24.5 million in working capital, and earnings per share for the last 2 quarters has been 4 cents. For the second quarter this year was 1 cent per share. All of that we feel reflects very positive. And as we look forward through the balance of 2020, we really feel that Delta 9 is well positioned to continue to expand, continue to capitalize on these opportunities, and really in a position of our own in terms of strength from a financial and operating results. I think with all of that said, from a presentation standpoint, I will turn things back over to Brandon to come back on, ask some questions, and then start to loop in some folks from the audience. So everyone who is on right now, again, please do keep in mind things are open for questions. Please jump in here whenever you like.
Awesome. And John, I appreciate the time going through all of that. You know, a lot of these investors, I can see some familiar names. I've heard your story before, but I also look and I see names that I haven't seen in our chat rooms and various different things before. So if this is the first time hearing the story, I hope you enjoyed that presentation as well. And like John was saying, let's turn to the questions now. We'll start going through them. But if you hear a question that maybe it sparks a secondary question or whatever it be, throw it in there, please. We'd love to hear from you. So quite a few came in. So we'll start from the very top here. The first one is from Tom. He said, or he asks, would D9 ever consider a merger with another company? or considering acquisitions now that valuations have come down? So looking for a merger or looking for maybe acquiring someone else?
Yeah, no, good question. I think there's certainly an abundance of opportunities emerging, both on the retail and wholesale side. Through these types of corrections, and we're now starting to see a number of bankruptcies, things like that in the Canadian cannabis space. It really does create opportunity for strong operators to capitalize. So whether that's distressed assets, again, on the retail or wholesale side, creating opportunity, whether that is, call it more of a merger of equals or a roll-up strategy where you look at us and another one or two mid-sized operators that are all profitable but perhaps undervalued. And we feel that there's a good way to unlock value there by creating a larger, more profitable entity that perhaps has more of a relevance from a capital market standpoint. Yes, all of these things are certainly on the table. Where I feel fortunate is that we're in a position where we don't need to rush into an M&A deal because there's some impending issue that we're trying to combat from the company standpoint. So, when we look at these acquisitions or mergers, we want them to be accretive. There need to be synergies, there need to be efficiencies. Really, there needs to be a strong strategic and financial rationale. As well, obviously, we need to position in any of these transactions that this is unlocking value over the short and long term for our shareholders. So all of these are things that we would consider when we're looking at those types of things. But, if I had to point to one area where I think the company will be certainly active, it will be in retail on the acquisition side. We see across the Canadian prairies fairly fragmented retail picture. So we, a lot of one-off operators, a lot of independent retail operators, a lot of opportunity then for us. I think to look at expanding through acquisition, where you chain a number of these together, bring it under the Delta 9 brand, they become a stronger operator as part of a chain. There's opportunity to increase the competitiveness of those stores, to really leverage the existing clientele. And also for every retail store that we add, it's driving distribution of Delta 9 product into the market, so helps with our wholesale business. So we feel that fits very well into our vertically integrated model. But of course, we're hearing in the Canadian cannabis space there's an oversupply and there's a dearth of retail stores. So to me, that points to that there's opportunity in expansion in retail over the near term.
Very, very detailed answer. I appreciate that. And I was just turning over there as I have a very rare thing right now of someone saying, is anyone having a harder time hearing Brandon? It's usually never an issue. So I turned it up a little bit, and I'll put more of my my real voice in instead of trying to tone it down a little bit. But I appreciate the answer there. And I'm hearing much better already there. Perfect. Well, let's go to the next question here. The next question is for Matt. He says, hi, John. The company has implemented and succeeded in using key performance indicators. The company posted their best quarter, posting 2 consecutive quarters of net income and 3 quarters of positive Ebitda among growing revenues. The share price is down over 20% since announcing earnings. What can the company do differently to bring in new shareholders? As of right now, a lot of investors don't feel the fundamentals are paying off. Great question. And it's one of those things that's very interesting about this space, but I'll hand it over to you there, John.
Yeah, no, it's a good question. Obviously disappointed in some of the market reaction to the results since the release. I mean, obviously we enjoyed a fairly significant run up into the results. So this may be a little bit of a case, and we saw this with a few other operators into this earnings season where there was a real run up into the announcement and then a real sell off afterwards. So it may be a little bit of a case of, speculation around, buy the speculation, sell the news type of thing. I don't think that's reflecting any material disappointment in terms of the earnings or the results or the fundamentals. Overall, I think the challenge that we run into in the Canadian cannabis space, or the cannabis space in general, is share prices, valuations, liquidity, et cetera, over the last number of years have been predominantly driven by retail. And with the sell-off over the last 18 months, many retail investors have turned away from the space. They're now turning their interest to more exciting things over the near term, like mining, gold, obviously some of those other sectors, in a real position of strength right now, and that driving a significant amount of interest from retail shareholders. The industry has also not matured to a point where institutional investors, at least long or fundamental institutional investors, are ready to participate. They want to see profits. They want to see a track record. They don't feel that they're missing out by not getting in on day one of an idea. They want to get in once that idea has been a little bit more proven. So, unfortunately, a little bit of a case of bad timing, where we started to find these long institutional investors starting to become interested in the cannabis space. And as a small aside or anecdote, we met with our investor relations team and an institutional investor who controls a $40 billion fund, long fundamental fund out of the US. This was in about March last year. And he had just taken a position in Canopy around, I believe, $75 a share, and was looking for other investments in the cannabis space. He didn't do well. And suffice it to say, he's pushed back from the table for cannabis for the foreseeable future until the numbers and the metrics and the fundamentals are starting to make a little bit more sense, and wait for the dust to settle. And I think that's reflective of the experience that, I would say a number of investors have had in the cannabis space over the last 18 months. We continue to see disappointing results from large operators. For example, Tilray, guys who are supposed to be leaders in the space, posting misses on revenue and earnings. Although I would generally say that this earnings season was less apocalyptic than previous, less large write-downs and asset impairments. There are some lingering, I think, concerns from investors and even hedge funds around inventory levels being quite high for the space. But, again, over the long term, it's difficult to point to companies that continue to produce gains in revenue, that continue to post profitability time and time and time again, that are not able to bring in investors and attract a higher share price, or start to begin to create value through things like dividends or share buybacks. When you're a profitable company, there are a number of tools and levers to use to create shareholder value. But I think a lot of our focus still today is on growth. We are a company right now doing an annualized revenue run rate in the area of 50 million, an annualized net income run rate in the area of, call it 8 to 10 million. That's strong, but it's still small. Our challenge here is, how do we get to 100 million? How do we get to 150 million? How do we build a critical mass where now there's a relevancy from a capital market standpoint? And again, a number of ways to do that: through organic growth, through acquisition, et cetera. So, I again, obviously disappointed in the nearer term market feedback that we've been getting in terms of the share price. But again, long term, we remain kind of driven that this is a company that will be built on fundamentals, and will continue to create value through expanding and creating real financial and operating results.
Yeah, and if I may as well, John, I think you nailed it in the sense that a lot of speculative money will find speculative plays, and cannabis, especially when it was first coming out, was a speculative play, and now it's that in between. Now it's that for that institutional investor, like you're just saying, they're looking for companies who can put up multiple quarters, maybe even a whole year of showing they're pushing forward, having actual income coming in, things like that, because now you're de-risking that play. And as time will go on, I strongly believe cannabis will not be in the speculative space. It will not be in that high flag. It will be a legitimate business, a legitimate sector in which you look at proper fundamentals. I've thrown this up here. It's the EV to sales ratio comparison that John from our team, different John, had put together. But it goes to show the enterprise value compared to the sales of various different cannabis companies in this space. And the reason why we put this up is we're talking about value. We're talking about share price and things of the like. Look at Delta 9 at a 1.5 ratio EV to sales. They're being discounted so much compared to, look with Canopy, with Cron, with Flower One, ACB, Tilray. They're multiples higher for where they're basically, for the revenue they're taking in. They're getting so much more in their enterprise value. They're getting so much more in their market cap compared to a Delta 9. I think over time, as people do see this story and they do see the value in this, there's a lot more room for a Delta 9 and some of the smaller players who've done a very good job with their companies to increase shareholder wealth than a lot of the bigger players where, quite frankly, I don't know how they're going to hold some of those numbers. But I wanted to throw that up there because it paints a good picture of what we were just talking about.
Yeah, and I think as well, Brandon, even just this chart shows a little bit of the divergence in it. It's not just the Delta 9s of the sector that are necessarily being undervalued. You see even in Afria at a 2.75, and posting, I think, very positive revenue numbers for this quarter. They're obviously diversified into their European pharmacy business, which is providing stability, but it's also giving them a backbone of profitability on which they can rely to continue to look long-term in building their cannabis business through, again, organic growth and acquisition. I think positive Ebitda numbers as well in this quarter from Afria. That's several sequential quarters. So to see them being discounted to a 2.75 versus, again, a Tilray or ACB at over 6, these numbers, these metrics are not making sense versus, say the Canadian bank stocks where you could point to them and, look at things like return on assets and return on equity. And they're all fairly comparably benchmarked around PE and the dividend yields and things like that. So, again, the sector is not there yet to be trading on fundamentals, but it will be. And you cannot really point to a mature sector that's not trading to a large extent around fundamentals. So we will get there. And again, that frankly creates an arbitrage opportunity for investors who look at a Delta 9 or a Village Farms or a Fire and Flower or a Fria and say, hey, once they start to trade up to a 4 or 5 or 6, like a lot of their peer group, I've made quite a bit of return on my investment. So that's where we really feel the opportunity is from these levels.
Absolutely. And what I've done here, if everyone looks right now in the handout section, I'm going to push share here. This chart you can now download from your computer. You'll see a little orange dart. So we've made that available for you so you can have that for the future as well. Coming back into the questions here, because there are quite a few. So we'll start going through here. The next one, to make sure I don't miss any, is from Jason. John, when assessing retail store acquisitions, do you have a target IRR you were aiming for to ensure proper allocation of capital and return on investment?
Ooh, good question. We don't necessarily use IRR in terms of our assessment of stores. We have, I'll call it a benchmarked revenue and Ebitda multiple that we look at. We want to ensure that there's a return on, if there's a cash component of an acquisition, that the return on the cash component is over a certain threshold, that the return on the full investment, including any share-based compensation or otherwise, is under or at a certain threshold. So there are a few metrics that we use. There are other factors as well. We find operations where perhaps the product mix in store is not there, or perhaps they overpaid for their lease, but there's an opportunity for us to get in, negotiate a longer term lease with the landlord at a better rate. And, again, bring in a better supply chain and more of the back end functions that we can support. And not that we're looking for turnarounds. Frankly, I don't think we are looking at any stores right now that are non-revenue producing. We're not looking at buying any permits or licenses where we then have to go build out a store. Those are not of value to us. So it's more of a conventional private equity model where, if we can roll all of these together and pay 0.5 times revenue, and yet we trade at upwards of 1 times revenue, those acquisitions will be accretive. If they're producing positive Ebitda, or at least Ebitda at the store level, that transaction is accretive. And again, you roll some of these together, and while there are modest dilutive implications to share-based acquisitions, at the end of the day, if we can reach that critical mass from a capital markets relevancy standpoint to start to trade up to an EV sales number like you're seeing on the chart here, we've done our job in terms of unlocking shareholder value. So again, a number of aspects that we do look at, some of them more financial based and some of them more we call it the pillars of retail, the location, product placement, store design, and layout. Is this actually going to fit as a roll into a Delta 9 store, or is it so departed from our retail store concept that it doesn't make any sense. So a lot of things factor in there, but there are a lot of opportunities emerging in retail from an M&A standpoint right now in the Canadian cannabis space.
Perfect, and I appreciate the answer. And I'm actually going to skip a few questions. I'll come back to them because I know many people are probably watching me go down from top to bottom, but just because this flows so well into it. Jordan asked the timeline for the Caniston, I may be saying that incorrectly, store opening. Can you elaborate on a cause of delay that may be there?
Yeah, so it's just licensing at this point. I mean, the store is fully built out. It's stocked with ancillary products. All really that's remaining is to bring in the cannabis products and open the doors. The staff have been hired. They're essentially temping in at our other stores, but they're fully trained. They're ready to go. So Manitoba opened up, I believe it was June this year for new applications. They have said as a part of that, they are looking at quote unquote new store applicants prior to existing or incumbent retailers. So there's been a little bit of an emphasis on those new applicants. Frankly, all of our paperwork has been processed. We're really just waiting for that final approval at this point. So, you know, it's a little bit like a Health Canada approval. Now, this is municipal, so it's MBLL and LGCA and the province of Manitoba who handle the licensing process for these stores. But, you know, it becomes similar to Health Canada, where they send requests for information, you send back all the information, and then you may just have to wait for a few weeks to hear back before they come back and say, oh, hey, actually, we need, you know, this additional piece of information. But at last we're hearing all of the information is received. We really are on the goal line, simply waiting for that license to be in hand. So, you know, again, confident that is going to be over the near term. It's a great location for us, very high traffic. Caniston Boulevard is the pronunciation, Brandon, which is the location for us. You know, and anyone who knows very high traffic, very high visibility, strong location partners. I think we've got a Safeway, Home Depot, Tim Hortons, Wendy's, Bank of Nova Scotia, Dollarama, all in very close proximity on our side of the street. And the traffic flow is in the tens of thousands of cars a day through there, really catering to that entire southwest quadrant of the city in a very high traffic location. So I think will be a very strong location opening for us, and again, should be very near future here.
Perfect. Glad to hear, and thank you for answering that question. The next one here is from Fred, and he's asking, if you don't already, you should build. Oh, I like this one. There was a comment. I asked for it to go into a Q&A. He said, if you don't already, you should build a few pods and offer it to students at a local college or apprenticeship programs to learn under your brand and growers. It's a beautiful facility. I threw in the YouTube video from when we went out to your facility and filmed over there because someone was curious about it. And yeah, so based off of that, do you have any plans to be working with nearby schools or apprenticeship programs and growers and things like that of using your technology and basically teaching them how to grow cannabis in some sort of way?
No, a good question. And actually, I mean, for anyone wanting to see a little bit more in terms of the facilities, please do hop on our website on our investor section, just delta9.ca, and then click invest. There is a corporate video there. It's about 2 minutes long. A lot of great video of the facility. Brandon, I know you guys did a great job on the walkthrough as well. So you know, between those few, as well as any of the still shots on our investor presentations, et cetera, there's a lot of great material there, and really should highlight, you know, how we're treating this as a manufacturing environment and a real state-of-the-art platform. In terms of co-op programs, training programs, things like that, you know, we have an extensive training program when we onboard growers into our facility and operations here. Make sure that they're doing everything, you know, call it the Delta 9 way. We have worked with a few, community colleges across the country, bringing them essentially, I'll call them modestly modified grow pod units, a little bit different than what you would see here, but there are a lot of co-op programs now looking to train people for the cannabis sector. We do work locally with Red River, with the University of Manitoba, on bringing on students every year to be a part of the operations here. Nothing quite in terms of, you know, setting up kind of demo facilities or anything like that at local colleges, but, you know, we are certainly looking to cultivate talent, and, you know, as well looking to bring over people who perhaps have experience from black market. and are looking to bring that into the legal industry. Of course, then we need them to be following all the Health Canada rules and compliance and all of that. But no, it's a good comment. I mean, certainly, something that the cannabis industry needs to do looking forward is to make sure that employment opportunities and training, and really that we're creating career paths for people to look at cannabis and attract a strong talent pool.
Very well said. Appreciate it. And yeah, it'll be very interesting to see the next generation. This place, the sector keeps changing, and it's very, very cool to watch actually out in front of us.
If you look behind me, you'll see a mural of our facility. I'm not actually in the facility right now, but I'm in my office, but it does look very similar.
No, it's a fantastic facility. I'd love to see it with all the other. I know it was before the grow pods, the initial, I think it was the 80 or whatever that huge chunk was. They were there, but not in operation. It must be very cool to see all those working at the same time.
Oh, yeah, fully operational now.
So we have Matt with another question here. It's a little bit longer one, so I'll go slow with asking it. If the company sees this sector far away from trading on fundamentals, in my mind, it implies in a lot of our minds the share price will not hit the debenture conversion of the dollar shares. Why wouldn't the company upsize their loan with Western Financial and pay off the debentures at a discount to par? This would save the company $300,000 to $400,000 quarterly in interest payments while allowing the company to use funds for acquisitions. That is a detailed comment and question.
You must have a finance background. No, very good question. It's certainly something that we consider. The debenture. So I guess firstly, to address the first component, I do still feel with a two-year runway here, and to the extent the company is undervalued currently, that there is still a strong chance or probability that we'll be trading at or near or above the debenture conversion price over the next 24 months. So, as you look forward at that point, the opportunity then to equitize that debenture through conversion, at or near maturity, does play in as well. You would hate to, be buying back those debentures and using cash, which is really king right now. When there would have been an opportunity to see that being converted into equity and cleaning up the balance sheet without the use of cash. At the same time, using cash to buy back the debenture is foregoing an opportunity to invest that cash in further expansion opportunities or acquisitions or otherwise. So there is certainly a cost benefit or trade-off. At the same time, I would emphasize we do have a very strong relationship with Canadian Western Bank. I think as a company producing positive earnings, positive Ebitda and cash flow, there's certainly opportunity for us to explore conversations to be modifying or upsizing that facility, and look for a portion of the proceeds to go towards something like a normal course issuer bid to be buying back those debentures in the market, particularly if there is a drop. I know at certain points over this spring, we saw the price of those debentures in the market. And for I think I saw a question come in, are the debentures publicly traded? Yes, they are. They trade under DN.DB on the TSX. At some points, the price of those has dipped even as low as 60 cents on the dollar, maybe even a little below. So, I mean, opportunistically to be purchasing those debentures and canceling them at a large discount, and to your point, freeing up, quarterly interest payments, et cetera. I think there's certainly some merit there. So, well questioned, and certainly something we're considering into the future.
Perfect. I appreciate the answer there, John. Moving on to another question here, also a very long one. So I'm going to say this one very clearly here. Jason asks, he says, John, in a little under 2 years, you have about $10 million in convertible debt coming due. It almost seems the same, with conversion prices above 121, which would represent more than 100% of the current D9 share price. I know 2 years seems like a while, and your numbers continue to track in the right direction, but any concern over how they will be repaid if there is no incentive for holders to convert into equity by the time it comes due? Do you have any contingency plans you are working on as a just-in-case risk management exercise to refinance that debt if need be? So I believe he's piggybacking off the previous question.
Yeah, so similar question. I mean, between our mix of cash right now, at over 6 million. Again, access to cash under our existing credit facilities, around 8 or 9 million. Opportunity to increase those facilities, again, as needed through conversations with the bank into the future. Opportunity to continue to see positive cash flow from operations, which I believe we did a little over 3 million in positive adjusted Ebitda for the first 6 months of this year. So, you stretch that out for another 12 months, companies likely sitting in a positive, very positive financial position. If that is not contributing to an increase in the share price, then you have to more seriously be considering, what are we doing with the runway we have left to refinance that debenture or pay it out outright, or be buying back again opportunistically in the market. So, all of these are options. I don't want to say we're worried about it at this point. This wasn't a one-year convert, as we saw many of our competitors enter into, which created not only an overhang on the stock, but also an impending cash crunch issue, which in many cases equitizing those debentures at steep discounts has been punitive for equity holders. So, I think we're in a much more fortunate position, a much stronger position than many of our competitors have been. And again, in terms of am I worried at this point? No.
Thank you there. The next question is from Jason as well. He's asking, John, your margins up until the past quarter have been very solid. They took a dip, I imagine, related to some COVID-related issues. Do you think things will improve in this aspect in Q3 to move back towards margins in previous quarters?
So it wasn't necessarily COVID-related in the second quarter in terms of the impact on gross margin. More of that is that if you look into our financials or our management discussion analysis, you'll see a breakout of gross profitability by business segment, where our retail business is close to 25% gross margin. So that's quite low versus our wholesale segment and our B2B segment that are over 50%, so relatively high. Obviously, more of our revenue mix coming from our retail segment. So on a consolidated basis, the gross margin or gross profitability was down to 38%, I believe, from 42% in the first quarter. Again, I do believe that throwing more of that revenue mix into those other categories will put us in a stronger position from a gross profitability standpoint. As well, 2.0 products, both in wholesale and retail, again, carry a little bit higher gross margin. So should contribute to increased gross margins across all of our business units. But overall, I don't think concerned or overtly concerned that our margin profile is too thin to support the company's operating expenses and SG&A. We run a very lean ship here. I think we have a total of 9 vice presidents and executives at the entire company, which I think Canopy has that in their corporate development department. So, we run a lean ship, and with a focus toward throwing that to the bottom line and creating profitability, really, again, demonstrating that the business model is sound. So, it's something we'll keep a keen eye on. If at some point retail is creating a large component of our overall revenue mix, we would have to, analyze whether that margin profile is sustainable, but not overly concerned right now.
All right, well, we'll move over to the next question, which is from Bobby. He says, sorry if this was answered already, but how many provinces and territories does D9 sell to right now? Is it mostly Manitoba focused?
Yes, so 6 provincial markets were Manitoba, Saskatchewan, Alberta, BC, Ontario, and Newfoundland currently, with Ontario and Newfoundland being our nearer term markets that we've deployed into. You know what, in terms of revenue mix, I think only about a third of our wholesale revenue is into the province of Manitoba on average the last few quarters. Alberta is a big province for us. We don't necessarily provide a breakdown market by market, but that's an interesting concept that may be something we should look at incorporating into our quarterly KPIs to give investors a sense of where product is flowing. We see certain strengths and weaknesses across these markets. We are anticipating Ontario will be a very strong market for us as Alberta and Manitoba are. But no, overall, I would say a rather diversified portfolio in terms of that wholesale revenue mix across those geographies.
Yeah, and speaking of geography, it works really well that he asked the questions back to back here. The same investor asked, do you plan to export anywhere else to other countries?
Good question. It's something we're certainly exploring. We have been in discussions with a few groups from Israel and Germany. Certain of these markets are requiring EU GMP certification, so that's not something we have for our facilities right now. It is something we may explore into the future. Export's an interesting concept, although, to be realistic right now, the entire volume of product exported from Canada is quite insignificant in comparison to the domestic opportunity for the recreational cannabis space. And, frankly, as it plays towards brand creation and brand recognition, anything that we would look to export, kind of takes away from our opportunity to create brand awareness with the Canadian consumer here in our own backyards. So, I don't see it necessarily as a near-term cash cow, certainly for us, or a near-term focal point. Of course, as these international markets open up, we expand our supply capacity. These become conversations that are a little bit more relevant. But my general sense is that the next 2 to 3 years, barring any near-term legalization in the United States, our focus will be here on Canada. And then perhaps looking opportunistically to international markets. But, I do always say, the next 25 years, there's going to be significant expansion in international markets, and we will absolutely be looking to participate in the upside that comes along with that. But first things first, let's create a profitable business here in Canada.
Absolutely. And I know a lot of companies did have that business model of exporting to Germany and different areas, especially the flower, and they ran into a few issues. Almost every company I've had, so that's a lot of money put into that, and so to be continued on the export to other countries. It'll happen, but we will see. Jason asks, good to see expansion of retail sales front to drive growth on the retail sales front. Just curious though, what is your same store sales growth has been like? Sorry, it was worded a little bit strange there, but essentially saying great to see everything from the retail side of things. But they're just curious on when it comes to same store sales growth, how has that been like over the last little while?
So we opened our 4th cannabis retail store in Q3 last year. So Q4 and Q1 this year were all same-store sales growth. Q2 as well, again, we point to opening 2 additional locations, although to be realistic, that came with about 15 days left in the quarter. So vast majority of Q2 revenue was also same-store sales growth. So it has been, I would say, quite positive across the last number of quarters. Obviously, a key metric that you look to in retail. And again, I think we continue to see that our consumer base is expanding and our product lines are expanding, our average cart size expanding, et cetera. But no, it is certainly a key metric that we look to and has been quite positive over the last number of quarters for us.
Perfect. Thank you there. This one is from Todd. He says, some countries have very low cost of production like Colombia and Thailand. How does Delta 9 plan to compete on the budget weed market?
Yeah, I mean, good question. We see that in Canada here as well, with a few players pivoting to the outdoor grow where, I mean, from what we're hearing, the product can be produced for, say, 10 cents a gram. The challenge is that it's selling for 15 cents a gram. It's only extraction grade. It can never really be sold as flower for consumption. I'm aware of a few outdoor growers here in Canada who are attempting to position that their product could be sold as flower or as a milled product into pre-rolls, although I'm quite skeptical. I find it hard to believe, given the emphasis that we're seeing from the Canadian consumer on quality and potency, that an outdoor grown product will be able to achieve the prerequisites to be sold as flower. So, that's not to say it's a horrendous business model, producing something for 5 or 10 cents and selling it for 15 or 20. As a farm, that may make some sense. Canada is an incredibly restricted market when it comes to cannabis imports currently, and I would anticipate that will be consistent over the future. These international markets do not have the same standards that we do for cannabis cultivation, processing, analytical testing, meeting all of those Health Canada good production practices standards. So, I think it unlikely that you see a Colombian or Central American player or otherwise, coming to the Canadian market with $1 a gram retail weed, and that blows everyone out of the water. I think more realistically, those outdoor operations in low-cost jurisdictions start to play a key role in terms of creating biomass for extraction. I think, if anything, actually, that'll be quite positive for the Canadian industry, where, relatively speaking, our extract and 2.0 products are expensive. On a cost per milligram THC basis, they're expensive. Gummies, chocolates, etc., are priced high. Or relatively speaking. So I think there's an opportunity there to be importing product for extraction purposes, to be sourcing lower cost distillate, to be creating lower cost 2.0 products. I think at the end of the day, that's going to be good for the consumer, probably bad for the black market. But again, not overly worried about outdoor grow from some of those jurisdictions really impacting our business model.
Yeah, fair enough. And I agree with that as well. It's there was a lot of them that started growing these massive crops out in Colombia and various different areas. But since then, personally, as an investor, I haven't heard much from them and what's happened from it. So we'll have to wait and see there. Just let everyone know, we are going to shut off new questions from this point. There's about 4 or 5 left to go. But if you do have more questions, please reach out to John and his team. They're there to answer your questions, throw them an email or anything like that. But we're going to stop any new ones, but we're going to go through the last few that are here right now. This one is from our Discord chat. I pulled this one in because I saw it in there, so I wanted it to be asked. And I think you very briefly were somewhat mentioning it already, John, in the sense that this investor is asking, at what point does a company consider a dividend? Obviously in growth mode right now, so not right now, but when?
Yeah, good question. I mean, we've considered implementing one just to make a little bit of a splash from a capital market side and being the first cannabis operator to declare one. No, I mean, more realistically, I think we're seeing a better return on capital, through reinvesting that capital and again, continuing to grow the business. I want to say if we created a dividend today, the positive aspects or implications from an investor standpoint are not necessarily going to be adequately reflected into the share price. So while, it would have an impact, it may move the needle modestly. I don't know that it's creating enough value for investors at this point. I think there would be questions if we were to implement one tomorrow around sustainability of that, particularly versus, why offer a dividend versus paying off debt, at least over the nearer term. I think realistically over the future, you get to a point where, if you're creating sufficient cash flow from operations and it can't all be reasonably invested into growth or paying down debt, you don't simply stack cash on the balance sheet. If you're not seeing an adequate reflection of value in your share price, that should be returned to the shareholders, whether it's, again, through share buybacks, which come without a tax implication, or through dividends. So all of those are tools in the tool belt. But I want to say, we need to get another few years down the road here. But at no point will we be sitting here idle, stacking cash quarter over quarter and mulling why our share price is not reflecting adequate value. At some point, that needs to be written. As the second largest shareholder in Delta 9, I can tell you that is top of mind in terms of creating shareholder value over the long term.
Perfect. Appreciate the answer there. Our next question, this is more a comment, so I'll read it out, though. It's from Bob. He's asked a few questions prior. He says, a long positive track record may lower the interest rate paid upon renewal of the convertibles, since it'd be de-risked, I think. So he's going back. He was one who was asking some of the debenture questions and things like that. So just a comment there.
Yeah, and it's a good comment. I mean, we know who our largest debenture holders are, and frankly, I think that plays to our benefit. They're long, they're supportive of the company. Share price gets up to $1. You negotiate a few-year renewal, a reduction in interest rate, but you lower the conversion price by 10 cents. They hop all over it. And again, it's a great position to be in versus some of our competitors who end up with $100 million debenture reaching maturity. They don't have the cash. They can't do a new debenture issue, at least not on terms that would be reasonable. And the debenture holders end up owning the majority of the company. And we're very much not in that position here, especially with our debt load is very reasonable. right now. So, again, certainly something to consider over the long term. And, I think at the very least, getting a normal course issuer bid into the market, buying back some of these debentures whenever there's depressed pricing or opportunistic pricing, it does have merit, certainly. But again, I overall feel the company is quite well positioned to be refinancing or find a strategic alternative that is not punitive to the shareholder to take care of that debenture in the future.
Yeah, and I think a lot of shareholders have that on mind, because exactly what you just said there, where we've seen companies have much larger amounts, of course, but then they have to refinance it, and you turn into this really, really nasty death spiral of now you put certain terms into it, and then we've seen companies take over. And it's nice to hear that this isn't the case with Delta 9, of course, but I know that's why some investors are always looking at it. When's that coming due? Because they've seen it in other companies. That'll be across the cannabis space for a while. Going on to the next question here is from Stuart. Stuart asks, in June, an announcement was made with regards to an association with the Manitoba Hotel. Is there any news to report with respect to possible retail outlets operating?
No formal news as yet. We are working with the Manitoba Hotel Association and with their members. A couple hundred hotels, I believe, are members of the association. A lot of interest from these hoteliers in terms of setting up either an age-restricted, so a standalone cannabis store, or simply offering sales of cannabis through their hotel lobby or snack bar or something to that effect. So a lot of interest. It's pretty early stages. Again, Manitoba just opened up in June. So of course, for any hotel, they're having to build out special areas or install security features, et cetera. But we have met with a number of these hotels. There's a lot of differing, I'll say, business plans on how they can integrate cannabis revenue into their operations. And I think there's a number of potential avenues for revenue and value for us, whether it's operating the retail outlet itself, seeing retail revenue and earnings, and using that as a lever to expand our retail store footprint, or whether it's simply working with these groups on their supply chain, making sure that they're well stocked with Delta 9 products, increasing our sell-through from a wholesale perspective. Again, all of these are potential avenues for us, but really wanted to emphasize when Manitoba made the announcement that we're opening up that we're looking at the Manitoba market strategically. We have huge market share in the Manitoba market. We're about 15% of the stores. I believe we're about 47% of the market share as of May this year from the most recent StatsCan figures. So, we're the big player in the Manitoba market, and we're going to continue to be.
Yeah, very well said. Appreciate that. So we have our last two questions here, and in great fashion, they're going to be very detailed. So once again, I'll read them. I'll read them slowly and clearly here. This is from Jason. Can you ask John if he thinks liquidity of shares is a limitation for any institutional buy-ins? Has this come up in any conversations with funds in the past? I believe John and his father own about 1/3 of the company alone, leaving a much smaller float than meets the eye. They possibly sold some of their stake earlier this year to position a large investor as a question mark. So does John think this has been holding them back at all in terms of getting that institutional buy-in?
Yeah, so a few limitations in terms of liquidity, as you pointed to. Myself, my father, I think we own a little over 40% of the company. Obviously, that's limiting the float of shares out there that are necessarily free trading on any given day. We do have a large number of investors as well that are quite large. I would say strategic investors holding $1 million to a few million shares, and they're not necessarily selling. So that as well is creating some liquidity limitations for the stock. I think our real challenge, and this is a pitfall that a number of small cap companies run into, is you're non-profitable, you don't have sufficient liquidity, and you don't have a large enough market cap. So how do you break out of that? Those doldrums? Well, I mean, firstly, as you become profitable, that now starts to check the box for a number of investors who wouldn't invest in a company that's not profitable. From there, liquidity can be addressed in a few ways. I mean, through any of these acquisitions, just organic growth through things like stock option plans, PRSU plans, et cetera. Increasing the overall, pool of shares will naturally start to build liquidity over time, working with market makers. As we have one right now, if we are looking to uplist to any senior exchange in the U.S., like the NASDAQ, I believe you have to have 3 or 4 registered market makers, ensuring a reasonable amount of liquidity. So, I think a few tools in the tool belt over the next few years in terms of checking the liquidity box, and then market cap as well. Again, it will grow organically with new shares being issued. It will grow through acquisition. It will grow, I think, through just a relative increase in the valuation of the share price. So, again, you look forward at a company that's looking to build from 50 million annualized revenues where we're sitting right now to 60, 70, 80, 100 million and beyond. At some point, there's that critical mass where now you are profitable, you have liquidity, you have a sufficient market capitalization for a fund to come in with a $1 million, $5 million, $10 million investment, where they feel reasonably they can accumulate and unwind a position within a reasonable amount of time. So, it is certainly coming up in conversations. Is there a magic wand to break out of that? No. I think gone are the days where I can pay a promoter a few $100,000 and poof, liquidity starts to appear in the stock. And frankly, that's the feedback we get from all of our financial advisors is, the Wild West of the cannabis space is over. If you try and pretend like it's still that space, you're going to put a lot of money into promotions activities that won't necessarily have a good return. So, again, we don't necessarily have a light switch that we can flick that's going to turn up liquidity. But at the same time, I think we're positioned well, given the company has reached that position of profitability that, there are institutional eyes on our stock. We speak with institutional investors who are looking at the cannabis space. Again, most of them are sitting on the sideline right now. They don't feel that there's a need to get in any meaningful way. They may be taking small positions, but that's not really driving huge volume in the market. They will buy when a stock is dipping or where they feel there's a real undervalue situation. But again, it's not driving meaningful share volume of buying or selling right now. So all of this, again, to be improved over time. But liquidity certainly is a consideration, one of those things that we need to improve to get where we want to be a few years from now.
Yeah, appreciate that. The answer there. Our last question. Now, I did see another question come in, John. I know that we are past the time. It is from a long-term shareholder, so I may turn to that one extra. So forgive me there. I want to be able to reward long-term shareholders that are really sticking around and take the time today to be here. But it will be our last one, because we did close that window a few minutes ago. But the second last one here is from John, or forgive me, from Matt. And he says, "Hi, John. When will the company's bottling facility be up and running officially? The company currently has 8,500 kilograms and packaging ability of 25,000 kilograms. Is there opportunity to package goods for other LPs with a clear ability to package more than your current capacity is once online?"
Yeah, certainly. So the bottling room is up and running now. I believe there's one final piece of equipment that we needed to get some techs out from BC. They are out next week with travel restrictions lifted now to be installing that equipment. So we will be fully up and running, operational, and I'll say operating at efficiency likely by the end of this month, if not very certainly by the end of this quarter. From here, we are purchasing product from some of our small micro cultivation partners. Currently, we are purchasing product on I would say, a more limited basis from other LPs, again, opportunistically, where we're seeing that there's a real dip in the cannabis wholesale market. It's something that we will look to be more active in into the future. And if we do not have internal production capacity, but we feel that we can buy and sell a product and make an adequate margin that's making sense for the company, very certainly we would be building our wholesale capacity by purchasing products. So it is certainly something we will be looking to.
Absolutely. In this last question here, and we'll conclude our presentation and webinar after this, is from Jack. And he's saying, things have been going awesome for Delta 9. As a long-term shareholder, it seems like there only ever has been maybe one hiccup, the deal with Westleaf. You would have a very unique perspective on how that played out. And I wonder if you could tell the story from your view or what you're able to say.
Yeah, absolutely. So, I mean, full story in terms of the Westleaf investment, we invested $3 million in a facility there, which was to be built out as a cultivation facility. A little bit of a pivot in our limited partnership with them was toward now making that into an extraction facility. There were some cost overruns and other issues that we ran into on the facility. We looked to divest our position into shares of Westleaf's parent company, which is now Decibel, after they went public. Realistically, we felt that we needed to get away from non-operating partnerships where we did not have full control over operations or assets. We wanted to, control our future from there. We ended up divesting into 5.6 million shares of Westleaf. We do still currently hold those shares. They are all liquid. Obviously, there was a massive run-up in Westleaf's share price and then a subsequent sell-off to, I believe they're around 10 cents a share today. We continue to work with them, obviously, on the on our supply agreement for 2.0 products, which again should finally be in the area of bearing fruit. I think that will be positive for them from a share price perspective to be starting to see meaningful wholesale revenues of 2.0 products, both through their own retail outlets, through their own wholesale distribution, and through their relationship with us. Their retail chain has been performing well over the last number of quarters from what we've seen in their financials. And otherwise, the introduction of their merger with Quest, or WeGrow, with the Quest branded cannabis products. I know, at least from the Manitoba market, I believe Ontario as well, the Quest products, they are priced very premium. They sell very well. There's quite a good brand following for Quest products in the Canadian cannabis market. So, again, we're a long-term holder of Decibel. I think we will continue to be, at least for the foreseeable future, unless, we feel that we are better to monetize that investment. I believe the value or current value of those shares would be in the area of $700,000 versus our initial investment of $3 million, where we did capitalize on some flow-through losses from that partnership, but was rather modest in the context of the entire investment. So that is an investment we're underwater on right now. I think speaks to why we're not necessarily making non-operating minority investments in cannabis companies or meaningfully into the future, as much as we have taken some small equity stakes in exchange for services over the last few years. So we'll call that a miss. Again, at the same time, I think out of that has come a positive operating partnership. And again, we continue to be long on Decibel over the long term. So, it's been interesting to see how the industry has played out, and really that volatility in capital markets has come at almost anyone's guess at certain points over the last several years. So it's been really hard to pinpoint, when doing those types of deals, am I getting in at a good entry point? I believe at the time we divested, it was about a $15 million profit, which has now turned into a $2 million loss. So, again, obviously speaks to the volatility we've seen over the last 18 months in the cannabis space, which has obviously hurt investors. But long-term, again, we continue to feel that there's value there. And will be interesting to see how that partnership develops moving forward.
Perfect. Well, I appreciate fitting that one in, John. I know it's always a busy day for executives, and we allotted, I think it was 45 minutes of time. So I hope I haven't thrown off any calls or meetings that you have coming after this, but some really great questions were coming in. And for investors who took the time to be here this morning or afternoon, depending on where you are, I want to make sure we went through those, because there's some great questions in there as well. So I appreciate everyone. This will be this is recorded. You'll find it on our YouTube in the coming days, so you can rewatch it or share it with others if you want to be able to do that as well. And John, just for some closing words for the investors who are here, but also who will be watching this in the near future as well.
Yeah, Brendan, thank you very much for having me, and thank you everyone who joined on for the live chat. Some great questions in there. It's helpful from our end to obviously to be getting a sense from investors of what more is, what are you wanting to see more of? So this has been helpful from our end as well. And again, thank everyone for taking the time. For any further questions, comments, or information on the company, please hop onto our website, delta9.ca. We do have an investor page or segment there as well. Just click on Invest or Investors. It'll take you through all the updated financials, corporate presentations, et cetera, are all there. And of course, Brandon, thank you for having me on today.
Absolutely, my good man. Well, as we end this here, it has a few seconds of a countdown. So once again, everyone, thank you very much. And if you're watching this and you are on YouTube right now, be sure to hit that subscribe button. You'll hear all the different stuff that we keep putting on here for Delta 9 and a lot of different companies